Okay. Welcome, everybody, to Stock Talk Live. I am Catherine Murray. Great to see everybody. And I'm here with David Driscoll. He is the founder, president, CEO, and portfolio manager at Liberty International Investment Management. So welcome, everybody. And David, great to be able to catch up with you. I think so many of our viewers know you for over so many years now. So great to see you. Thanks for joining.
Oh, my pleasure, Catherine. And it's been actually almost 40 years I've been in this.
Wow, 40 years. Okay.
I'm showing my age.
I think we all are a little bit, especially during COVID. But hopefully we're getting out of that. And that's going to be one of the big question marks, I think, for so many in terms of where we're at in the pandemic and COVID and any lasting impacts, because it will affect how we invest. So why don't we first start, David, with your kind of top-down view of the world? What's your outlook these days?
Well, it's difficult only because of what's going on in the world, because we have to prepare for what may come in the macroeconomic situation, whether it's inflation, deflation, or in the worst case scenario, stagflation. The problem that we have right now is the COVID variant that's coming out of India. We could be getting back to normal, but then the COVID variant, if people aren't vaccinated, could shut us back down again. If we see OPEC continuing to hold back on supply, or the supply chains continue to be embattled, then obviously that can lead to more inflation. Of course, the Federal Reserve starts to raise interest rates, which would have an impact on the stock market. And then the worst case scenario would be stagflation, which gets us back into the 1970s, where you have a stagnant economy with inflation. And in the 1970s, just to give you a little backdrop, neither stock nor bonds had positive returns through the entire decade. And that too.
Wait, David, I'm going to ask you to sit a little bit further back, maybe from your speaker. Try that again. So what was the takeaway from the stagflation?
Well, the stagflation would be the 1970s scenario where there was no oil embargo, there was no gasoline available in the United States. The Americans had the Vietnam War deficit to pay for, and inflation peaked at around 18% and caused the Federal Reserve to raise rates hugely. So through the entire decade of the 70s, both stock and bond markets had negative returns. So, we've had a wonderful decade of growing returns, especially since 2017, when the United States cut corporate taxes from 35% to 20%. Since then, we've had hyperbolic rises in the stock market since then. The concern, of course, is, are we taking all the returns today and sacrificing that growth in the next decade? So those are really the biggest concerns that we have. And what we're trying to do as a firm is to mitigate all of that possible scenario risk by having a little bit in every sector, in every type of investment. So we're not going to shoot the lights out on the upside, but we're also not going to lose 30 or 40% on the downside.
Fair point. It's interesting though when you say having money really it sounds like even more diversified than what people perhaps traditionally think. That's what I'm hearing from you. What do you specifically mean?
Well, we're trying to manage risk in various ways, because you have risk in everything. You can start off with systematic versus non-systematic risk. Systematic risk is the risk of being in any market. You take your money out from under your mattress and put it into stocks, bonds, real estate. And you just have to live with that risk. Non-systematic risk is the risk of all the other risks that are out there, and the way that you can manage that is to diversify. So we're trying to diversify among stocks around the world, so we're not just in Canada or the U.S. We're international in scope as well, by different industries, by size of the companies, and also within a portfolio structure, not letting stock prices in individual companies get too big, be too large a percentage of the portfolio. So we're trying to avoid...
Recording in progress.
Mm-hmm. Sorry.
We're trying to avoid correlation risk and concentration risk as well. Because correlation risk is
Yeah.
All of the Canadian banks.
It's difficult though, David, because I think that, when you really think about a major event, even when we really learned about COVID and the market was going down 1,000 points day after day after day, it was really hard to find something that was uncorrelated. And I think that this is really important for people to understand, because in the moment, it seems though everything ends up being correlated, just like during the financial crisis. And often that is true for the majority of investments. But then, when the dust settles a little bit, I think that you see certain areas that actually do recover and get back to the uncorrelated nature that they might have. Like, how do you talk to your clients about that? Because when stuff happens, it tends to all go down in the moment.
Correct. And we saw that in 2008 when it didn't matter what sector you were in the world, they all moved in Canada in the same direction. So there are different ways based on asset allocation, because of course bonds are half as risky as stocks. So when the market was falling 30% last March 2020, the bond market wasn't going down with it, it was actually going higher, because people would sell their stocks to go high in bonds. Before the Fed started to cut rates, yields were still fairly high where they are today. The second way that we were managing risk was holding cash, because rather than buying put options, which do have transaction costs attached to them, by holding cash, it's what seems to be known as a short position, a synthetic short. So instead of buying put options, you can hold the cash. And the way to think about it is, Catherine, that if you have 100% stock portfolio, but you're 20% cash and only 80% invested in stocks, that cash works like a short position if you're not long the market. You take the 80% that you're invested in stocks minus 20%, and your exposure net is only 60%. So when the market fell 30% last March, our all stock portfolio were only down 14 to 16%.
Right. Wait, David, I'm going to ask you to sit a little further back, and when you speak a little bit more to the right. That works a little bit better. I don't know why. Where are tech people? But yeah. So just to kind of reiterate there, you're basically saying that if you have a sizable amount of cash, it acts as a bit of a put in a portfolio, as opposed to going out and buying puts, getting into the options market, and those transaction costs, those fees, if they expire, worthless. And you're just using it as protection. You do actually have protection because you've got, 30% cash or whatever the right amount is. What are you doing today, though, in terms of the right size for your cash position?
Well, we're still using 20% cash times the equity weighting. So if the client's 100% stocks, they'll have between 50 and 20% cash. If their asset base is 60% stocks, 40% fixed, they'll have about 12% cash right now.
Got it. Okay. Now, certainly one of the difficulties as it relates to the market right now are valuations. And I loved your note at looking at the PE. Your calculation is 29 times. I think is it the S&P or the TSX you're looking at? 29 times. Adjusted though 22 times. And you make the point, which is an interesting point, that a lot of analysts on Wall Street and Bay Street make adjustments for earnings. We should talk about exactly kind of what those adjustments are, and then people can decide whether or not they agree with them or not, and therefore decide whether or not the market is in fact stretched or not. So what's your thinking there?
Yeah, that's the way that I think Wall Street works, because they try to get people interested in investing and want to keep buying. And as a result, the banks, brokerages can do a lot of underwriting and earn their investment banking. So, of course, the adjusted earnings are being used based on EBITDA, which, of course, has a lot of wiggle room, as opposed to using GAAP or the international standard. So that's an issue right there. Another one that a lot of companies game playing right now is changing their inventory calculations from FIFO to LIFO, or the opposite, so that they can manipulate earnings that way. So when you look at the adjusted earnings, then the argument will be that the market is fully valued based on where interest rates are today. If you look at GAAP earnings or IFRS earnings, you start to see that they're about 20% higher than what the market is actually showing, and therefore a little bit more expensive than it should be. The other thing that I've also noticed is that if you look at the Dow Jones index, the difference between GAAP and adjusted earnings on tech stocks is over 25%, which is a huge differentiation. So that the tech stocks are writing down or taking expenses or adjusting acquisitions because they're calling them one-offs, even though they're making acquisitions every year. And overall, the Dow Jones difference between adjusted earnings and GAAP earnings is almost greater than 10%.
Right.
So bottom line is that earnings are artificial and cash is real. So that's why our focus has always been on companies that generate free cash flow, because their adjusted earnings and their GAAP earnings tend to be the same, and therefore they're more reliable.
So when you're looking then at free cash flow, what looks attractive today, and let's also understand, given where we're at in the market and the unknowns, essentially, in terms of, we're talking about the variance and whether or not that comes into focus again, or if we are on the recovery and we will see the roaring 20s. How are you positioning the portfolio? Are you positioning it for a number of different scenarios?
Yeah, that's correct, Catherine. If we get back to business again, we're kind of like returning to February of 2020, and it will then be the market moving higher will be determined by corporate profitability. And we want to own demographic plays. Of course, medical devices are a perfect example. And one stock that I know that you have known for a long time is Thermo Fisher.
Sorry, Thermo Fisher Scientific. Okay.
Yeah, had a great run last year during COVID. It was up over 50% in value. And then for the first 3 months this year, it started tumbling down and it started to pick up again. Because demographically, you've got all of these aging populations in the Western nations who have a backlog of elective surgeries to have to deal with for the next couple of years. And companies like Stryker Corp will benefit from that moving forward. For Thermo, they're doing end-to-end research to manufacture of COVID medicine. They now have a contract with Moderna to manufacture that. So even though the stock may be down year to date, it's still one that's worth investing in the long run, because they are private equity light, they and Danaher in that space, where they generate so much free cash flow that they can pay off all the debt from the acquisition and then start looking for more acquisitions, grow their dividends at roughly a 20% clip, when the historical average for all the public listed companies worldwide is about 6%. So you're getting 3 times the cash payout. And of course, that just means your income is going to double 3 times faster than the average.
Wait, David, and we apologize for the difficulty to hear. So I'm going to recap for a second here.
Sure.
So Thermo Fisher Scientific, is the ticker still TMO?
Correct.
TMO, okay. The stock's down because of elective surgeries being postponed during COVID.
And also the fact that if we don't need to be vaccinated again, then that was what really sent the stock price higher during the COVID lockdown too.
Okay. And they grow their dividend at 20%.
Correct.
I'm kind of surprised that, well, I don't know. I mean, I guess we'd have to look at who's holding the stock these days, but that it's not, that more people haven't picked up on it then.
Well, the medical device sector did very well last year in life sciences, but they fell back this year because everybody was expecting that COVID would end, get back to reopening the economy, and therefore the valuations of these stocks had probably run too far too fast. So they started to fall back on the expectation that their earnings may not grow because of the demand for COVID PPE.
Okay.
Stuff like that. But now it's starting to turn around and pick up again because relative to their peers, their profitability has been growing at both companies, Danaher and Thermo, at a much faster clip than their competition.
Okay, that's an interesting, great name to kind of revisit for people. What else is interesting to you these days from a stock perspective?
Agriculture stocks, we just lost one one of our small caps, Raven Industries, they had come to the market with the first driverless tractor.
Mm.
So they just got bought out. They were trading around $30 or $35 a share and taking up at 60. So my big concern right now is all of my small caps that have a market cap of, say, less than $10 billion, with all interest rates so cheap and everybody leveraging and all the SPACs and private equity companies out there, they all disappear because getting access to money is quite cheap to buy ideas. And we also lost Cantel Medical, which makes sterilization for dentist offices earlier in the year to one of the companies that we own Steris for. But again, I'm starting to see that the expectation that we could lose some small cap stocks that we've owned for a long time in this environment. But agriculture is interesting right now.
Yep.
From the standpoint that you've got commodity prices rising, so if we do have any kind of return to normal and plus inflation, then of course we've seen commodity prices rise. Rather than owning the outright gold or resource stock, we like the companies that are involved in the spaces. So one of the ones that we do own that's done very well this year is Lindsay Corp, and they make irrigation equipment.
Sorry, which company is that again?
It's called Lindsay Corp.
Lindsay Corp.
On New York is Larry and Norman, LNN.
Okay.
They make irrigation equipment, but they're now using satellites to look at farmers' fields, find which part of the field is dry, move the equipment over, and it reduces water usage and also increases yield. So their stock in the last year has gone from roughly $60 to about $160. And that's on the back of rising corn prices or commodity prices in agriculture, because now the farmers have more money to spend. So they're starting to allocate more of their capital towards irrigation.
Your firm style to necessarily, but if one believes that there is a commodity super cycle going on, that all the negativity surrounding energy, the energy industry, energy stocks has now taken a toll on supply, which is the bull case for anybody out there who these days believes that we are in a super cycle. Would that not be a fundamental reason enough for you to step into the energy sector?
No, because long term energy will have its little blips along the way, but you can look at utilities over a 15-year time frame. They've far outperformed the energy sector over time with greater dividend growth. If you're taking on twice as much risk, but not getting the long-term reward that you see. The issue right now is, yes, energy prices, like that portion of the TSX is up over 35% year to date. I'd rather invest in companies that generate free cash flow that have access to the energy sector. So a company like Farmon Industries, because they make all of it, they lease and sell the Caterpillar equipment from Manitoba East. So all of the mines that are in Quebec, Ontario, etc., will be leasing or buying the Caterpillar equipment from Farmon to dig out the gold, silver, or the oil sands, what have you. Or a company like Nutrien, where we can take advantage of the rising commodity prices and the fact that Belarus now is having to deal with countries not trading with them, so Nutrien can raise prices through chemical tax cartel, raise prices and start to sell more to other people worldwide, have the profit. So there are other ways to play without having to be directly involved in the producers themselves.
Right.
What you do is you get half the risk, better stability and free cash flows, and therefore longer-term growth. Short term, I don't pay attention to because I'm not a mutual fund, and I don't have to answer to consultants or the pension funds to have a performance report.
Okay.
The way that I want to invest is an easy way for investors to think about it is we own 30 stocks in a client portfolio. If they have 30,000 employees, then they've got 1 million people out in the world working dividends grow, the share prices will follow. And free cash flow companies historically perform much better than the average stock index. So you've got 30 names like that, and just sit back and let them do it.
Yeah, and you make the point as well, and there's so many different styles to investing. There's so many different ways to invest, and you just kind of have to have your area of expertise, I think, and be really good at it. And you make the point that you're investing for a longer term time horizon versus being a day-to-day trader. There's nothing wrong with that either, but that's just not your style.
Right, because we're not investing with the flavor of the day, but we're also looking for edges as well. So the fact that we don't trade actively means that more of the money is staying with the client, reinvested as opposed to going to the broker or the transaction cost or the taxes. By rebalancing the portfolio, so if one stock, if we have 3% average weight among 30 names, if one becomes a 6% weighting, we'll automatically sell half. And that enhances returns long term over 10 or 20 years by 1 or 2%. Because essentially what's happening is one stock is rising twice as fast as all of the other names in the portfolio. And chances are it's then going to fall back at some point in time. And so Fisher is a perfect example of that, where it ran from 250 to 500, fell back to 470 by rebalancing and then reallocate those to make up less than 3% because they all have the same characteristics. The ones that are less than 3% are probably going to have their day in the sun next. By investing outside of North America, because there's 550 million people in North America, when you include Mexico, 7.5 billion people out there in the rest of the world. International returns have beaten North America by 1 to 2% a year historically. So having a global portfolio in itself starts to give you an edge as well. And then there are other little edges as well. If you're buying in October every year, then you're avoiding September, October bad market. And returns for the indexes October to October rather than January to December are about 5 or 6%, but the Liberty names are upwards of 19% in that time. So there's the opportunity for huge outperformance. And that has worked, back tested all the way back to the 1980s.
To the
1980s.
1980.
It's got more than 30 years of data. And by buying in October every year than any other month of the year has enhanced returns about 3/4 of the time, as opposed to the historical norm where markets go up 2/3 of the year.
But you know what, David? It's hard to hear you, and I want to get this right. You're saying buying in October?
Yep. So buying in October,
yeah.
It's usually you'll get bad markets in September, October. You get more enhanced returns by buying in October than any other month of the year. So when you look at returns from October to October, because not only can you get a stock correction like that, but you also get Q4, which tends to be the best quarter of all the corporate earnings, and dividends tend to be rising at that time as well. Okay. So the returns that I'm looking at just since year 2000, the Liberty name on average are up 19% versus the benchmark at 5 to 6. So there's a huge edge there by buying or waiting to allocate your cash in October.
Interesting. Interesting.
We do a lot of that work to try to look for little edges.
Yeah, that was your point. Just because you're not trading every day or whatever doesn't mean that you don't have an edge, and it's just kind of how you want to approach it and looking for those opportunities to make sure you do have the edge.
Perfect.
Okay. I'm going to actually take a viewer question. It's from Paul, and the question is, what's a reasonable expectation in terms of return on your portfolio if you have it managed over 10 years, less the fees, versus the index without fees, which doesn't have fees?
Yeah. Well, we wrote about that in our December and March newsletter, so Paul can go to our website and read about it. But essentially, again, free cash flow tends to beat the benchmark over time. And the goal for any portfolio manager, if you can beat the benchmark after fees by 2% or greater, then it's going to compound at a much better rate than what ETF.
So, sorry, 2% or more beating the benchmark after fees.
Yeah. Because that's the reason why you don't want to invest ETF. Second reason is, if you look at the S&P 500 performance so far this year, 50% of the top 10 uh, uh, subsectors have earned 16% versus the S&P overall of 50, which means the rest of the subsectors have returned -1. So if you're not having all of your money in those top subsectors, which is essentially the subsector, then you're underperforming.
Right.
So you can beat the ETF simply with proper diversification and free cash flow. We screen about 7,000 companies worldwide for significant and consistent free cash flow growth. By doing so, we whittled the list down to about 162.
100 and how many?
About 162
Okay.
of those 7,000 actually generate consistently growing free cash flow. And because we want to avoid correlation risk, that brings our stock portfolio down to about 75 names, which we choose 30, based on current valuation for new clients.
Okay. Got a question here as well from Darren. What instrument is David using to hold the cash? That's a good question. A lot of people struggle with what to do with their cash. How do you hold it?
Yeah. There are a couple of ways that we can. For the most part, they're in bankers' acceptances because we want to be able to move quickly if the market moves and allocate that cash when need be. So rather than buying, say, a 1 or a 2-year bond and get a little bit of a pickup in yield, we may have a liquidity issue where we can't get rid of that bond to raise the cash to buy the stock. So we take the hit on the T-bills or the bankers' acceptances. We're only paying about 0.2%, but that's strategic, and that's just waiting for the time to get a market correction if one happens and take advantage of it with higher yields and low prices. And it will work out in the long run.
Okay. Darren, I'm curious, David, I'm looking at Darren's email to you. Sorry. In terms of finding yield in this environment, are you looking at all, in addition to getting strong and growing free cash flow and looking for dividend stocks, are you looking at preferred shares at all, or how are you incorporating preferred shares and or the fixed income market into your portfolios?
Fixed income is the toughest discussion I have with all of my clients because most do not understand bonds. Because corporate bonds trade on over the counter, so their prices change every day relative to GICs, which most investors will understand. But they have to understand that if we're buying it at par or a discount and insure at par, then the price movement during the life of the bond is relevant. It really matters with the yield. What we're trying to do on fixed income portfolios for clients is if they're in a taxable account, then half of the fixed income will be bonds, which 10% of that will be inflation protected bonds. And the other half will be preferred shares. The problem with the preferred share market right now is that they've rallied back in a huge way because they were yielding 8%, now they're yielding about 5% overall pre-tax. And most of the preferred shares are trading at $25 par value. So you're not getting a lot of value there right now. And the reason that's happening is supply is disappearing because the banks and insurance companies are buying that back their rate reset preferred and issuing LRCNs because the LRCNs, which mature in 2080, are tax deductible for the banks and insurance companies, whereas the dividends that they were paying to retail investors not. So those have disappeared, and we're pretty much left with utility preferred and very little else. Second thing that's happened is the rate resets have come roaring back because the 5-year Government of Canada rate has risen last year, and therefore makes those rate resets attractive. If you're getting a 5% coupon relative to where 5-year interest rates are on government bonds, say 1%, you're getting a huge pickup. What I have to try to educate my clients with is that this fixed income is there only for income purposes, where the preferred shares can earn income greater than what stocks are paying right now, because the S&P 500 yields about 1.25%. So if you can make 5% instead of 1.25%, We can use that income either to live on in retirement, or we can take the cash and reinvest it at a faster rate.
Right.
Stock market. With the inflation protected bonds, they're a better idea than GICs right now. Because if you're buying, say, a 1-year or 2-year GIC at 2%, and if inflation this year is running at 4%, then obviously your real returns will be negative. With the inflation protected bond, so for example, the Canada government has a 3% coupon maturing in 2036. You get the coupon of 3% plus the inflation rate. So your real return stays positive throughout the life of the bond. And because it's a longer term bond, if interest rates stay low and the Fed does start to taper sooner rather than later, they're going to continue to rise in value because long bonds recently have been falling, rising in price, falling in yield, while the 2- and 5-year bonds have actually been rising, and the yield curve has been flattening.
Where do you stand though, or have you decided in terms of if you expect to see inflation, deflation, or stagflation? I mean, you're kind of positioning the portfolio for maybe all three scenarios, with I'm sure greater weighting towards certain areas, probably not stagflation. But the camp's really out in terms of deflation versus inflation, and maybe it's just kind of like somewhere in the middle, as steady as she goes, like it's been since the financial crisis. I mean, really, people have to wonder, why would it be any different this time in terms of the government fiscal monetary policy being able to spur inflation, given the fact that they haven't, even after all of these quantitative easing programs around the world. So with that said, do we muddle along here at lower for longer, or does something change?
We have to have a huge catalyst like China moving into Taiwan and forcing the U.S. to make a decision what they want to do. The aging population in the West spends as much in retirement, therefore that tends to be very inflationary as well. So on fixed income components of our portfolio, we're looking at all of the different ones. If we get hyperinflation, that's where the inflation protected bonds come into play. On the current bonds, because yields are so low, we prefer to have a 10-year laddered bond portfolio. Because when you have a laddered bond portfolio, you're protecting against reinvestment risk, whether rates are going higher or lower. If rates are going higher, you'll have something maturing that can roll over into a higher coupon down the road. If rates are falling, then you don't have all these bonds maturing at once, taking on lower investment risk, or low reinvestment risk, where you might have had a 5% coupon, yields are now down to 2%, investors are losing 3% of their income on the bond portfolio. And if they're retired, that's a loss of income that they don't have, and they have to eat into their capital to replace. So that's the way strategically that we're dealing with all of the potential scenarios that are out there on the fixed income side.
Mm-hmm.
And we don't trade our bonds actively. We'd rather have the ladder in place and whatever happens, happens. The other thing that occurs is, don't forget, every month there's interest and dividends rolling into the portfolio. So I have to look at the percent weightings of stocks versus bonds for a balanced portfolio and decide then if I've got cash, what do I want to buy next?
What would be, we've talked a little bit from a stock idea perspective about owning some ag stocks and also medical equipment, Thermo Fisher Scientific. What about if you want an inflation play, and if you want a deflation play, what would you own?
The deflation play would be the medical device company. That goes hand in hand with the population. So again, people who have very sore hips or knees right now that need to be replaced, sitting in backlog, my guess would be it could be 2 to 5 years before everybody gets caught up. So in that time frame, prices can rise. So again, companies that have free cash flow also will have market share and pricing power. And that's the old Warren Buffett joke that if you have to have a prayer meeting before you raise prices, that's a very bad business. But if you can raise prices and your customers don't bat an eye, then you've got a very good business going on.
Right.
So that would be the deflationary kind of play. On the inflationary side, and of course, have companies that are kind of esoteric with rising commodity prices. So a Dover Corp has access because they make pumps in the oil field. You've got Belchem, which makes chlorine chloride, which is also used in fracking. So there are ways to play the inflationary cycle without having to be in the resource company.
Right.
You also have to understand that when you look at different industries, some are inelastic, such as the financial, utility, consumer stock, and the healthcare name. We want at least 50% of our stocks in those types of industries because they make money whether the economy is strong or weak, and they have pricing power. The elastic businesses that make all their money in the good times, lose it all in the bad times, and end up making little money over the long run would be the resources or the industrials. So again, we have to pay attention in that regard to what kind of stocks do we want to own, what industry sector are they in? Is it inflationary, deflationary, how much risk do we want to take?
And just to be clear, so you said Dover Corp, and then I didn't hear the other one.
The other one was Belchem, BALCHEM. Symbol on NASDAQ is Baker Charlie Peter Charlie.
Okay.
They make choline chloride, which is in infant formula for better growth, also in exercise formulation as well. And they've also manufacturing potentially. This is their wild card. They have a joint venture with a company that's looking at a drug for kids who aren't doing well. Anyway, they've got the manufacturing process in place if and when this company gets the approval.
Okay. And remind me, Dover Corp, ticker?
DOV, so David Oscar Victor on here. They're into many different types of businesses. Like they do RFID tags and for identification. They do all the refrigeration for the grocery store. You go into the dairy aisle and everything is being cooled or refrigerated. And then they also make pumps for the oil and gas sector. So they're more of a diversified type of company.
Interesting. Okay. David, we're going to wrap it here just because the sound is a bit difficult, but I think we got enough great nuggets for today. So thank you. I guess though, I'm just going to ask you to wrap it in terms of what's your bottom line to viewers right now? Again, just given the fact that there are a lot of unknowns in terms of really the big debate as it relates to inflation versus deflation, and therefore rising rates or higher interest rates or lower rates, it affects the valuations across asset classes. That's why, we're talking so much about it and why it's out there in the headlines and the news. And I know you also write about, kind of sifting through the noise. So I don't know if that's, a point that you want to pick up on or, just, I guess, your main message to your clients.
Well, the main message is be disciplined. Avoid the noise because be focused on what's best for you, not what's going on in the market. Because in our business, we have three types of clients. We've got the retirees, we've got the professionals, about 2/3 of our clients are entrepreneurs. So they're building their businesses right now and having to make estate planning choices and also how to deal with the cash as they get ready. Either to sell the business or to retire. And then we've got the younger generation, the kids and the grandkids, that have long runways of investing to go. I think the most important thing for all three categories is be disciplined. Make a
Discipline.
plan.
Discipline,
make a plan, stick to it, and don't veer from it. And you got to believe in what your ideals are and just keep doing it and rinse and repeat. And again, when I started investing in a big way as a portfolio manager, it was after working at Dominion Bond Rating Service in the early 90s, where we met with about 700 of North America's CEOs, treasurers, and CFOs. And the constant thing they talked about was free cash flow. And that's when the light bulb went on in this tiny little brain of mine. And then I started to investigate and they began to realize the free cash flow was key. And the way to think about it, Catherine, is that if a company is generating free cash flow, like in your own life, if you've got money left over after all the bills are paid, you have financial flexibility because you can save it, spend it, or invest it. Same thing with a corporation. If they've got money left over after all their obligations, they can increase the dividends, pay down the debt, buy back shares, make tuck-in acquisitions, allocate money towards research and development, stay relevant, and grow your market share over time. And if you've got 30 companies like that, whether we're in expansion, recession, or going nowhere, these companies continue to do business. They've got so much cash available that if their competitors are restricted, then of course they're going to grow their business over time. And if you're the CFO of those companies, they're sitting there at their desk with their feet up, going, okay, we'll allocate a third to rising dividends, a third to R&D, a third to tuck-in acquisition, and just keep it going. And over time, those are the ones that have outperformed. So when I was investigating those 700 companies at the time, the ones that generated the good free cash flows are the ones that are still with us today. The ones that didn't are long gone.
Okay.
So staying power is what happened.
Yeah, staying power and stamina in life. Two keys. David. Yeah, exactly. David, great to see you. Thank you very, very much. And appreciate you sharing your thoughts and expertise with us and stock ideas. I think people are, really wanting to learn more and more, obviously, about investing. I mean, you're seeing it in the retail flows. So I think the more information and access we can give, the better. So thank you.
Yeah, and it's my pleasure, Catherine. And we are a business that is all about education for not just my staff, because we've had night school internally, but we're trying to educate our clients as well, because quite simply, the more they understand, the deeper the relationship becomes. So education is a big factor in our business.
Nice. Yeah, as it should be. All right. We will wrap it